The Fed owns over $4 trillion worth of US garbage paper, and it needs to unload it without collapsing the global financial system. Not an easy task. Every time the debt matures and the Fed doesn't buy an equivalent amount, stocks drop. Therefore, quantitative tightening is directly correlated with stocks falling. Are you ready for the roller coaster to begin? You came here for the truth, so let me unveil that for you. Today we're going to talk about quantitative tightening, not quantitative easing, but tightening. We have the Federal Reserve holding trillions in bonds, and every so often they are allowing some of that to drop off. They're not buying an additional amount. So what happens to those bonds? Well, we need the market to pick them up. We need other buyers out there to say, I want some of that garbage, please send some over here. But it doesn't necessarily work that way. And I would have to venture a guess that we could be repeating the same cycles. Hold on to that thought for just a moment. Today in the stock market, as I record this video in the middle of the day, you're looking at 24,452. It's up 236, about 1% on the day for the Dow Jones. And this is something that I've been tracking for quite some time. We can see that the markets are still down over the last 6 months, but there are some bright signs that there could be a miracle here and then stocks would rise. All we need is QE4. That's it. That's all we need, everyone. As long as the Federal Reserve engages in QE4 from this moment on, stocks will rise, okay? Look at how much of this garbage the Federal Reserve has purchased over the years. You will see during the financial crisis what had happened here. I'll just get my highlighter to show you that we spiked up, I'm sure you're aware of this, to a point that was literally more money created in this period of time than all years before it. Instantly, more money was created all the years before it in the entire US history. Then they started to print more and more, and you could see that escalated to a point where they decided, okay, we're going to cut off QE3, we're going to stop it right there, and we will just hold it here for this moment of time. So they kept it here for a few years, and now we can see this minuscule level of quantitative tightening that has occurred. I'm going to zoom in, I'm going to show you closer there. But I wanted to give you a background for those who don't know, or just to really follow into this next statement I'm going to make here. But what we can see is that the Federal Reserve has not acted alone. You know, you have the Bank of England doing the same thing. You have the Bank of Japan doing the same thing. You have the ECB doing the same thing. You have basically Swiss National Bank, every other central bank, they're all doing the same activities. And that, my friends, is not a good sign when they have to engage in quantitative tightening. This here brings me to my next point. When we have all of this quantitative tightening occurring, it's a good thing to get rid of that from the central bank balance sheet, under the assumption that somebody else is buying it. Who's buying it though? Well, that's a very good question. I also wanted to note from here that this was the peak moment in 2015, January 2015, but practically all the same throughout all of 2015. It took this many years to go into really what has begun in very late 2017, the actual quantitative tightening policy. Okay? So in this period of time, we have seen month after month of minuscule, when you compare it to the total value of the balance sheet, dropping off, and they're allowing this to take place. Okay, they're not buying more, they are allowing that to take place. It's a very, very small amount, as I've said. Imagine it took all these years to to begin just this. So if you think about this, we peaked out at, let's say, $4.5 trillion. Today we are at $4.3 trillion. They have held on to all this amount. So during this period of time, they've sold off, let's just say, $200 billion. It took 3 years to sell off $200 billion in this garbage. 3 years. Now, they're saying they're going to, increase and get to more and more and more. That's fine if that's what's going to happen. But it's way, way too slow. During this period of time, stocks are basically waiting and seeing what's going to happen. That's why you see that real slowdown in the markets. It wasn't like before. Throughout 2017, I mean, you just look at the chart. If you take a look at the up until basically all of 2017, up until towards the end of January, you would see stocks just straight line upwards month after month. I think it was 13 months in a row, if I remember correctly, 13 months in a row of constant increases. So every month, if you held that stock or the index, let's say, every single month, 13 months in a row, the stock market went up. It didn't go down one month and then, doubled up the next month. No, 13 months in a row. That's obscene. That's unheard of. But as soon as they started to talk about quantitative tightening and the market saw this slide that was occurring, everything changed. Everything changed. Now, the VIX was that catalyst, that moment in which everything came down. But that's not the reason why the stock market hasn't come up yet. That was just a trigger point. The S&P 500 future on the last big QT day, quantitative tightening day, May 31st. Look at what happened. This is what occurred the last time we had that QT. The market came down. And I will show you more examples in a second. Why do you think this is the case? Well, we're being told that the Federal Reserve is the lender of last resort. They are there to backstop any losses. However, simultaneously, we know, and the market knows, the algorithms know this, that the Federal Reserve is now going to stop doing that. In the event that this actually happens, I mean, as I've said before, it's such a small amount. If they start to get to that 50 billion a month, 80 billion a month, if we get into that territory, then we're going to start to see that really escalating, and it's going to put a much bigger damper on this economy, on the stock market, I should say. The economy is totally separate from the stock market. Then we have this showing you specifically on June the 30th, okay? Highlighted right here, June the 30th, there's approximately $30 billion worth that will be allowed to run off, okay? I refer to it as sell-off, but it's not. They're not selling it off. They're just basically letting it, escape. They're not renewing. And this here, you look in the previous instances, they've done this before, in the previous months, and look at where, this is the future months, looking at where it will be all the way down and so on. It goes basically until November 2018. And it's just more and more. Another, what is this? Maybe almost 30 billion again throughout July and so on, all the way down the list. So they're going to keep doing that, about 30 trillion, maybe less. But what I was told, they told me in their very wonderful meetings that they have, that they would get to the point where they would be doing 50 to 80 trillion dollars worth in a month. That doesn't happen. I mean, look, all the way to November, that is showing us maybe 35 billion? Not even close. It's not even close to the amount. And that's going to be going on, years now that we've been experiencing all of these all quantitative easing methods that were completely obscene. Now I want to show you this. saved it for the end for any of those who are still here. Quantitative tightening. Daily S&P 500 returns on quantitative tightening maturity days. You will see May 31st, May 15th, and so on. Shows you how much in terms of billions here, 28, 25, 19, 24, and so on. And you can see the return. Only one moment in time this year, 2018, was it positive, and it was barely positive. That was January. That was before all this heat that we've been feeling in the markets. Ever since then, we've seen a direct negative correlation in between all of these actions. You know, they sell it off or they allow it to mature. They don't buy it back. The market feels the pain. The market feels the burn. Well, what's going to happen this time around? I don't know exactly. But in the last 5 cases, this has occurred. So we can expect the same thing to do so. If not, it's an anomaly. But ultimately, in the long term, if the Federal Reserve empties out that balance sheet, the stocks will feel it. There's no other way to put it, because this wasn't generated by real growth. It was generated by fake money printing. And you cannot sustain a market like that unless you're willing to print into infinity. Unless you're willing to make the currency confetti, you will not increase the stock market in the way that you think it will. And it will never, ever translate into the real economy. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. And I just wanted to say that if you want to know what's going on in the financial system, if you were never taught the financial system in school, you never got that financial education, well, these 2 books have it all. I took all of my knowledge from all of the books that I have read over the years, all of the people in the financial industry, outside the financial industry, all the thousands and thousands of audiobooks, hours of audiobooks that I have listened to, all the seminars I've been to, all the seminars that I've listened to, and so on, brought it all into 2 books that make it easy for anybody. If you don't know anything about the financial system, you could read this book. If you're in the financial system, you can read this book. In fact, I've had multiple people who have told me they are in the financial system at one level or another. They've read my book, they enjoy it, and they've actually said, my colleagues could learn a thing or two. All right, that's a quote. And so if you want to, have any interest in it, link is in the description of this video. If you're more interested in the audiobook version, you could take a look at that at themoneygps.com.